Today, we will talk about inventory turnover, what it is, how it works, and formula. Subject: Inventory turnover. Inventory turnover is a financial ratio showing how many times a company turned over its inventory relative to its cost of goods sold in a given period. A company can then divide the days in the period, typically a fiscal year, by the inventory turnover ratio to calculate how many days it takes, on average, to sell its inventory. The inventory turnover ratio can help businesses make better decisions on pricing, manufacturing, marketing, and purchasing. It is one of the efficiency ratios measuring how effectively a company uses its assets. The inventory turnover ratio is calculated by dividing the cost of goods sold by the average value of the inventory during the period. Cost of goods sold is used instead of sales in the formula for inventory turnover because inventory is typically valued at cost, whereas the sales figure includes the company's markup. Some companies may use sales instead of COGS in the calculation, which would tend to inflate the resulting ratio. The average value of inventory is used to offset seasonality effects, calculated by adding the value of inventory at the end of a period to the value of inventory at the end of the prior period and dividing the sum by 2. Inventory turnover helps measure how often a company replaces inventory relative to its cost of sales. A low inventory turnover ratio might be a sign of weak sales or excessive inventory, also known as overstocking. On the other hand, a high inventory turnover ratio suggests strong sales, though it could also be the result of insufficient inventory. The speed with which a company can turn over inventory is a critical measure of business performance. Inventory turnover is especially important for perishable and time-sensitive goods. For example, an overabundance of cashmere sweaters may lead to unsold inventory and lost profits, especially as seasons change. Such unsold stock is known as obsolete inventory, or dead stock. Two related ratios are the inventory-to-sales ratio and the days sales of inventory. The former compares inventories with net sales rather than the cost of sales, while the latter marks the average number of days it takes to turn inventory into sales. For fiscal year 2022, Walmart Incorporated reported a cost of sales of $429 billion and year-end inventory of $56.5 billion, up from $44.9 billion a year earlier. Walmart's inventory turnover ratio for the year was about 8.5, and its days inventory equaled about 42 days. Inventory turnover is only useful for comparing similar companies, because the ratio varies widely by industry. A relatively high inventory turnover ratio might indicate insufficient stocking, while low inventory turnover could reflect bulk orders or preparations for a product launch, rather than inefficient inventory management. Changes in costs and accounting policies may also distort comparisons. Inventory turnover measures how efficiently a company uses its inventory by dividing its cost of sales, or cost of goods sold, by the average value of its inventory for the same period. It is especially important for retailers. Companies will almost always aspire to have a high inventory turnover, as it reduces the amount of capital tied up in their inventory and increases profitability. However, high inventory turnover can also be a sign of inadequate inventory that is costing the company sales. A company's inventory turnover ratio reveals the number of times a company turned over its inventory relative to its COGS in a given time period. This ratio is useful to a business in guiding its decisions regarding pricing, manufacturing, marketing, and purchasing. It is of particular importance in retail. Here are 4 key takeaways. 1. Inventory turnover measures how efficiently a company uses its inventory by dividing the cost of goods sold by the average inventory value during the period. 2. Inventory turnover ratios are only useful for comparing similar companies, and are particularly important for retailers. 3. A relatively low inventory turnover ratio may be a sign of weak sales or excess inventory, while a higher ratio signals strong sales but may also indicate inadequate inventory stocking. 4. Accounting policies, rapid changes in costs, and seasonal factors may distort inventory turnover comparisons. Hope this would help. Thanks for watching.